evening, everybody. It's Wednesday. We call them Wisdom Wednesdays. I'm Frank Congilose. I'm the managing partner here at CNA Financial Group. It's my pleasure to be with you this evening and to, kind of give you a little bit of an economic and market update, along with Josh Graff over at Clark Capital, one of our strategic partners. Josh's background is CFA, works with advisors like myself throughout the country, and overall just a wonderful, insightful individual as it relates to markets and the economy. So to be respectful of everybody, seeing how it is a Wednesday evening and it is toasty outside, so hopefully everybody's staying in with the nice cool air conditioning. Without further ado, Josh, it's a pleasure to be with you this evening, and I'm going to hand the meeting over to you and let you get started, and I'll just be chiming in here and there, with some, points or questions or anything that we want to, kind of speak a little bit in more detail on. And I think you have control at this point.
Yeah, absolutely. I'll be sharing my screen in just a second, but it's a pleasure to be here. Thank you, Frank, for having for having me on, and happy to get started. As Frank mentioned, I'm a client portfolio manager at Clark Capital. My role is to explain what our investment team is doing in English to our advisors and our partners. And It's our mission to work with elite financial advisors like Frank to deliver the goals and objectives for our clients along with excellent service. What I'm going to do today, I'm going to highlight a few things that our investment team has been up to real quick, just some trades that we've made. It's been a crazy year. If you had gone to bed on New Year's Eve and woken up yesterday, you would see the markets are overall are up, 8, 9%. And you might go, well, that's kind of a boring year. We know that's not the case in reality. So talk a little bit about some of the things that we've done this year, and then I'll spend a little bit of time talking about our outlook, what Clark Capital is thinking moving forward. So I'll share my screen here. So just to touch on, some of our activity, what we do within our strategy, and we work with the total wealth strategy and some of our portfolios. It sounds like a model. It's not. It's active. What you can see here are all the fundamental things that we look at that make insightful decisions. And you'll see at the top these 5 areas that we'll touch on, and I'll talk to our economic gauges here in a little bit. But you'd see the depth of research that our team does to look at the markets. And specifically this year, here are some traits that we've made within our strategy. We went through some volatility and some of that panic. We all felt that in our chest during the month of April. Well, Clark was active as well. We actually had made the all-time high on the U.S. markets actually on February 19th of this year. We saw this as an opportunity. And some of our portfolios are diversified strategies. We actually went overweight. We can go over, underweight various asset classes. We went overweight equity starting with March 17th. And then we got a little bit more aggressive. We went through a lot of that tariff and policy uncertainty that vividly affected the markets on April 3rd and April 4th. It was the fourth worst 2-day sell-off in the markets going back to 1950. What was Clark doing? We were adding at the time, right, to our diversified portfolios and actively went a 10% overweight on April 14th. So, just some insight into some of our trading. We know we've seen that fear calm down. We've seen the markets recover. Actually, here of late, starting on July 21st, we did begin to pare back that overweight, right? It never hurts to take profits, pat yourself on the back for a good trade, put money back in our pocket. So again, just highlighting our trading, our activity, and we're able to profit for clients. Certainly here, given the volatility this year and the upswing we have seen in the market. So enough of that. But what I'm going to do now, I'm going to switch gears here, spend a little bit of time talking about our economic outlook. So give me a second to pull that up.
All good, Josh. Take your time.
So you should see the new presentation here coming up. And just to talk a little bit about our outlook. So you should see, those economic gauges, what we're currently thinking on the markets here. Our founder and chairman was a sailor. So we're doing things in terms of boating. Any place where you see the gauge to the right of neutral, we feel that's a positive, right, for the markets, perhaps a tailwind moving forward. Any place where you see the gauge to the left of neutral, we do feel that that's a headwind. Any areas you see are changes that we've made from the previous outlook. So you'll see we actually have two gauges right now in the positive position. We do think there's a tailwind to come here from monetary policy, perhaps some interest rate cuts forthcoming in the second half of this year. We also think there's a positive from investor sentiment. We'll talk a little bit about why that matters. We are in the slow or a slight negative position there with respect to valuations. We've seen prices recover in the markets from April, so perhaps maybe a headwind there. And we'll talk through that. We do have two gauges in neutral. Important that these are the five most important drivers that we have for the markets overall. I promise I don't have a hidden politics gauge on the screen here or in my back pocket. We do feel right that the fundamentals, truly matter the most. And a little bit of a summary here on our outlook overall. We had a really good second quarter, right? A recovery following that April decline. We did make a new high here in the U.S. markets. Diversified portfolios and bonds. I haven't touched on them. We hear a lot, concern about interest rates and bonds overall, but diversified portfolios have worked really, really well. Specifically, the bond markets, starting to show signs of recovery and have, playing defense when, markets and economies aren't behaving as well, right? That's what we expect from bonds, and they're doing their job this year. We do feel that the bull market out there is still alive. We have an interim price target there of 6,700 on the S&P 500. So, perhaps some appreciation still out there. We do have a fairly wide range for interest rates. I think we've seen really not many changes in interest rates out there this year. We're a little bit lower actually than where we started the year. So we'll talk a little bit about that. We did lower our growth forecast a little bit earlier this year around some of that tariff impact, tariff uncertainty, and we'll talk on the ramifications there on the economy. We haven't got any rate changes from the Fed yet. We also heard today no rate cut. They've kept rates unchanged. But we'll talk about that at its impact overall on the markets here. So just a quick catch up, right? A scorecard for how the markets have behaved. I know there's a lot of numbers on the page here. Just again to focus on that second quarter and on the year to date page so far this year. You'll see, right? Quite the recovery in the markets, particularly in the growth or that big technology area that we've seen this year. But, year to date, pretty even, right? Between growth and value. And again, some of those diversified aspects. International has been an excellent performer in diversified portfolios. And then you'll see overall, right? Bonds have been pretty good this year. Outside of perhaps municipal bonds, but overall a solid start to the year from a diversified portfolio perspective, especially following that market in April. Just looking at markets here overall, volatility is normal, right? And this chart here is just showing you how the S&P 500 has behaved during each calendar year. And what you'll notice is there's a lot of years where the lines fall below zero, whether that's for the full year or during the year. And you'll see that red circle there, right? We had 2023 and 2024. We really didn't have a whole lot of volatility. So, this year looking a little bit more normal, right? Volatility is normal. This is showing you, during the year, we do see at times where the market can be down double digits, at some point during the year. And note, the recovery there, right? And we always feel that in our chest, right? But the markets do tend to recover, right, in the long run for investors. And similar story here, right? Corrections during the year are normal. Again, to focus your attention, particularly in the green box here. These are garden variety things that happen. On average, 3 times a year, the market does go down 5% or more. Once every year, the market can drop 10% or more at times. We did see that a 10% correction actually in 2023, but we did not have a 10% decline in 2024. You also see, at times the market does exhibit perhaps some volatility, a little bit worse. Could anyone here tell me the last time we saw a 20% decline? 3 years ago, right? So right on schedule. We saw that a little bit earlier this year in April, and again highlighting, right? This doesn't feel good, right? We go through these, right, to have that roller coaster ride that equity markets put on, right, to have the mental fortitude. But what's most important is that usually these are buying opportunities as the market goes up, particularly in the long run. This year, no different. So, moving further in. Frank, any questions so far? Any thoughts?
No, it's as you're going through it, and I'm, just kind of, looking and watching, and I'm doing this a long time now. It's common, but it's always different. So there's always something different that triggers it, but it gets to be pretty common, when you look at it over a long period of time.
Yeah, and I think you and I have seen a number of different volatile events, right? They always say it's different this time, and that's like the most dangerous phrase to utter in the markets, right? And so while it is different, right, there's different aspects to it. We've seen time and time again, the best plan is to stay the course, and this
That's it.
time was no different. So just a few things here, specifically about the current situation to highlight. You'll see, the economic gauge, which we are currently straight up and down here in neutral. And you'll notice, right, we did lower that growth forecast. However, our base case, overall, we're seeing signs of slowing growth, but we're not anticipating a recession, right? And we lowered the growth ultimately on some of that policy uncertainty. But what we've seen is the resilience in the economy, in the markets this year. We'll talk about labor markets. We'll touch on inflation, egg prices, all sorts of different things that we're seeing. We'll talk about the consumer, right? Are we still going to Costco? Are we still out and about at restaurants and bars this summer? And we'll talk about that. Why does that matter? Well, productivity goes to earnings, right? And earnings drive stock prices. So just to touch on the labor market, I think as long as Americans are employed, we like to spend, right? And so looking at that employment trend here, we actually added 140,000 jobs in each of the last 3 months. You'll see in purple, that's our unemployment rate. That actually went down, ticked to 4.1 last month. We will get an update here tomorrow on what the impacts were on unemployment here in the month of July. But overall, this is a very healthy picture. Now, hires have slowed, so kind of touching on that slowing growth there. But what's important about that, and what's happening with layoffs? Well, they're not really going anywhere, right? That layoff rate has flatlined. Is still pretty low, remaining at 1%. Wages grew 4.4% over year, year over year, which remains above the rate of inflation. And on inflation, let's talk about it, right? You'll see here the amount of inflation that we were dealing with back in 2022, but clearly progress is continuing. The CPI, which is that index, the prices that come out from the government every month, there in orange, that actually came in at 2.7 on the price chart there. So you'll see that in purple. It's actually the fifth straight month the index of inflation has come in below expectation. So we were promised that massive inflationary impulse from tariffs, some of which has been pushed off, and there's still that potential, but it's not a foregone conclusion. And we really haven't seen a lot of the impacts just yet. We can look at other areas of inflation. There's actually something called the PPI, which is the producer price index, which, think commodities or suppliers or inputs into the economy, right? That might be a leading indicator of inflation. That actually came in negative for the month of June. So not really seeing that impulse there either. We saw, there were some things that were showing price increases. If you've been at the furniture store looking for goods lately, we've seen some prices go up there. No flashing lights or panic buttons there, but there are some things that have continued to come down. Vehicles, airfares. groceries, and yes, those egg prices have shown some pretty good signs of deflationary impulses. Yes, you did hear that correctly. New and used vehicles are not showing that impulse that we've heard about that's potentially coming just yet. So, with progress continuing there, let's talk about what consumers are doing. And you'll see here the difference between how people are feeling and what people are actually doing with their dollars. And you'll see there the orange line. That's how people have felt. The sentiment indicator, which we know came down pretty hard in April. But what did people do? They kept buying. So whether we want to call it, the front running of tariffs or panic spending, or people maybe are just bored. But overall, we've seen spending remain pretty solid, particularly this summer. We saw retail sales jump 0.6% growth month over month. We saw categories like building materials, garden equipment, other things like that, jump 0.9% last month. And people spending at restaurants and bars rose 0.6% month over month. Typical summer activities, as many in our area head for the beaches. So what you'd expect. Retail sales and consumer showing resilience as well. And I think this is probably one of my favorite charts when talking about the stock market because this is the relationship between the prices, the S&P 500, and the earnings coming from corporate America. I'm no PhD in mathematics, but the relationship between these two lines is really, really high. Ultimately, earnings continue to grow as well. We had that drop in 2022. We've seen a solid trend for earnings, which has continued into this year. We had Microsoft and Meta, two giant technology companies, report earlier. Extremely robust results. So we've got a lot of catalysts out there, whether that's artificial intelligence or innovation, and we're seeing continue to see signs of growth and resilience in earnings as well. Frank, any thoughts,
So
comments on the
as you're saying
economy
it,
overall?
because I know, people will look and they'll, wonder, is it a good time to get in? Is it time to get out? But, it looks as if, when you're going through that, earnings in alignment with, prices and things of that nature is that they're pretty much in alignment for the most part. It's nothing crazy.
Yeah, I think we're still seeing forecasted earnings growth. So,
Yeah.
investors, we definitely want to align with portfolio objectives for sure, and doing it in a meaningful way. But, if earnings are growing, prices can continue to grow. And I think that that's important for someone looking to get invested or involved here in the markets. Other aspects of things, right? So we continue to see benefits for in the future here from the monetary policy front. The Federal Reserve. We haven't gotten any cuts this year. We are in the slight forward position because we do anticipate a few cuts in the second half. Right now, the market is projecting for two cuts. So we had four last year. And right now, the market projecting for a few cuts here in the second half. And why do we talk about monetary policy? Well, if the Fed is lowering rates, typically that has been a tailwind for the markets. So you see here, this is where they are on that Fed rate. You'll see the line coming down here. Those are those cuts from last year. Again, no rate cuts yet this year, including this afternoon. But again, in the market anticipating two additional cuts here in the second half. What's interesting, and again, a little bit of a noisy chart, but I think what's important and what you'll see is overall the different types of environments we've seen with the Fed lower rates on. Whether the Fed is cutting rates slowly or they're moving really, really quickly. And you think intuitively, well, why might the Federal Reserve be cutting rates really fast? Well, maybe there's something that's broken. Maybe the economy is going wrong. Maybe the unemployment is skyrocketing, right? That they need to lower rates really, really fast. And what we've seen is that it's actually better for the market for them to gradually cut rates. And so that dark blue line at the top, we've seen the markets do really well when they're cutting rates slower rather than that panic environment which is in red. And you'll see that down here. So, ultimately, we believe that, the market can do better, particularly in a slower rate cutting environment. The light blue line is where we're at right now on the chart. So, a bit of a volatile picture there. But again, we do think that the slow cut cycle that we've seen, the slower, moderate approach, is overall better for the markets. Frank, any thoughts about monetary policy?
It's interesting as you're going through because if you watch the political headlines, it's certainly not as fast as the current administration would like them to move. However, when you listen to, say, Powell earlier today, it seemed like the economy's doing well and everything was going, according to plan. And he doesn't seem super motivated to have to do it anytime soon. However, it sounded like you had two of the, individuals that sit on the board when they're doing that, thinking that, they're heading in that direction. So it's starting to look like, the probability of the second half getting the two cuts are more likely to happen, especially if you're starting to get people that, are sitting in the meetings and starting to view it that way. And it helps both stocks and bonds. The value of the bond should be going up when that's occurring, and it should help on the stock market side. So it's all good.
Agreed. Yeah, touching on valuations, you'll see the gauge here. This is the headwind, right? So the
Yep.
slight headwind that we have with that gauge, and I showed you that market scorecard. We've certainly had robust returns, particularly in different areas of the market. So prices in some areas of the market are elevated. However, important to remember that valuations itself, right, the opportunities, the costs of business, right, isn't a great timing tool. I'll go to the beach, right? That 10-bedroom oceanfront property, right? That's not cheap, right? That's definitely going to cost you a little bit more, right? So, overall, style matters. We'll talk about, how successful and the earnings, of certain companies are, and how that impacts their valuations, or helps justify. Earnings are continuing to grow though. So we do still think that stocks have appreciation potential out there. Also remember that there's other markets that Clark Capital invests in. So we'll look at some other opportunities below the surface, maybe internationally, some other things. Moving in here. So what we're looking at is one metric that we use to look at the valuations of businesses. So we're looking and basically saying, are things cheap? Are things expensive relative to other time periods in history, right? Remember, we want to buy low and sell high, right? That's the goal in the long run. So what you're looking at here is the PE ratio. Essentially, how much are we paying for $1 of earnings, right? We want to make sure that we want more earnings, right, rather than less. So you'll see here three different lines. This is the Magnificent Seven, right? We have seven technology businesses, really large businesses, in the United States. They make up a lot of the market because they're really, really successful, right? Those are Apple, Meta, or Facebook, Microsoft, and Nvidia, Tesla, Google, and Amazon, right? Really, really robust businesses, and those are not cheap, right? They're 29 times earnings, right? You can see, after April, the recovery that those valuations have had. But below the surface, that's in green, right? So if I remove those seven companies, we're seeing much more attractive valuations, right? Something that's less eye peeling, right? Something around 19 and a half times earnings for those businesses in green. So, for Clark Capital, we're looking underneath the surface and we tend to buy individual companies. We're doing the active management here. There are times when just owning the market, right? That's important. You just earn the market return, and that's great. I think right now we're in a world where we want to need to look at the stocks within the market, perhaps for returns, opportunities moving forward. The next chart, another area that we look at, we invest in international markets. So taking a look at U.S. versus international valuations. Showed you that U.S. Evaluation on this slide before, but you see international markets only 14 times earnings, and you'll see the gap between U.S. and international here. Recently, where we may not have seen that gap in previous decades. There's times when the U.S. outperforms, times when the international markets outperform, but overall. We've seen international markets do well, as I showed on the scorecard this year. Perhaps those valuations are mattering a little bit more this year, and it could be an opportunity moving forward for diversified portfolios. And you'll see here, right? Now, there's justification for why the US is a little bit more expensive than international. This is a chart showing you the profit margin, and profit margins in the US are higher than they are relatively around the world. You'll see the US there in red, moving up and growing in particular. But the profit margin in royal blue there, coming in around 10%. So we're starting to see that move up and become more elevated. And looking at other markets and other profit margins around the world, again, definitely a reason to make sure that you own the best businesses around the world, regardless of where they choose to get their mail, and some opportunities for growth in other markets outside of the United States. Frank, any questions on valuations?
No, it's interesting is, for the last few years, it was US, 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 and, you can almost, just buy the S&P 500 and be content. But it's a little different world at the moment. And, when you look at it's a little bit different world, all of a sudden it looks a little bit more normal as the past, where other countries owning a good globally diversified portfolio, um, you're seeing more of that come back, and you showed it in the earlier slides with regard to international picking up. So having that diversified portfolio and the different asset classes with some international, makes sense. And then the other side of that is, we've been advocating, more of the active management side, as we do with you over at Clark. And also, if somebody was going to buy the index, sometimes the equal weight helps to bring down that PE ratio a little bit in the overall portfolio. So there's opportunities, but you have to be more strategic, which is, Josh, why we love dealing with Clark and, you going through this. So it's good.
Agreed. Last couple gauges here, a couple more thoughts of investor sentiment, which we do have in the positive position. This is a contrarian indicator. If there's any Seinfeld fans out there, sometimes I refer to this as the Costanza gauge. If you remember from one episode of
I like
Seinfeld,
it.
Costanza woke up one morning, he decided he wanted to do the opposite of what he said he was going to do that day that made him happier. So when George and his friends are jumping up and down about the stock market, right, we want to fade George, maybe be a little bit more cautious. However, when George is panicking, running for the hills, and wants nothing to do with the economy or the markets, we want to jump in with both feet. Why? Because George and his friends, time and time again, usually get it dead wrong. And when they are the most scared, right, that's when bottoms are formed in the markets. And markets, as mentioned before, do tend to recover from those fear levels being really, really high. As we know, George and his friends are very sensitive, so this is a sensitive gauge, but we are overall in the slight positive position. The other analogy we like to use here, famous investor, you might have heard of him, Warren Buffett. He's said to be fearful when others are greedy, and to be greedy when other people are fearful. And you'll see right there at the bottom, this is a usage of AI. But a famous quote of his, and getting that technology here into the presentation. But overall, you're looking at here, that blue line or purple line there. Essentially, what this is, it comes from a survey or a metric we look at. It's essentially a survey of George Costanza and his friends out there, non-professional investors that we look at. And what this reading is the percent of people that are bearish in that survey. It's a survey actually that's been around since 1987. It's called the AAII, or the American Association of Individual Investor Survey. And what we notice is that when the number of people getting scared or panicking tends to rise when the markets are panicking. And lo and behold, we saw this once again in the month of April there, where the percent of people that were bearish actually rose and got as high as in the 50s. But we've seen this subside as well. There's still healthy skepticism out there, but we've seen bearishness return to more normal levels. That being said, we're not, as low as we've been in the past too. So perhaps again a chance for some folks to come off the sidelines and participate in the more calmed markets here. Uh, and then just to touch on or wrap up with interest rates overall, we're in the neutral position here. They've been stuck in a range, right? They really haven't moved a whole lot. And as touched on earlier, right, declining rates have historically been a tailwind for the market. So just looking at interest rates here overall, you'll see this is the level of interest rates this year, all the way out to our US offerings out 10, 20, 30 years long, and then the offering or the interest rate up and down for that length of maturity. And so you see two lines here, the red line, New Year's Eve in particular, start of the year, and then the blue line a bit earlier this month. But you'll notice where interest rates have moved down this year is in the belly of the curve, right in the middle. Now, we've heard concerns about the federal debt, about spending, government spending, the deficit, and the dollar, and where these concerns have really been seen, more on the longer end of things. But I think what's important about this is we've seen this around the world as well. We've seen this with UK and gilts. We've seen this in Germany. It's essentially just investors asking governments to provide a slightly higher return for holding things out 30 years into the future. That's pretty uncertain, right? It's not necessarily a panic. Clark Capital, what's important is our bond strategy. We focus on the intermediate area. And it's important is that we have relatively higher interest rates over the last 5 to 10 years that we've seen. So, well, that's not good news for someone looking for a mortgage. It is good news for someone who, again, needs an asset class to perhaps play some defense that provides some income, especially for those moving towards retirement or somebody that needs diversification. So, with that, that sort of wraps up a lot of the discussion. I'll show the disclosures to make our compliance folks happy as well. But I'll toss it back to Frank to see if there's any questions or answers or anything to wrap up commentary wise.
No, the only thing I would, excuse me, Josh, bring up is as it relates to, when you kind of look at everything that's going on in the world, yeah, they've said a little bit that, they thought the reason why the tariffs, haven't impacted too much is because of inventories and they think people have been spending them down. But yet at the same point, the consumer looks like they're hanging in. It seems like they are cutting deals with different countries and so forth. Um, how does Clark look at it at this point?
Yeah, it's a good question. We're getting a lot. I look forward to the day when I don't have to remember what the word tariff means. But no, it's an important subject because we've had a number of deadlines here that have impacted the markets. July 9th, I'm not sure anybody on this call knows what that means. We did have at one point a deadline, right? We've seen that pushed back here to August 1st. But overall, we've seen cooler heads prevail, right? And that's really important. We've seen the tariffs be used more as a negotiation tool rather than something that is outright negative for the economy overall. And we've seen at this point, there was a statistic, I think 60% of the countries that were on that board that the president originally held up at the Rose Garden, 60% of those countries have made a deal at this point, right? And that actually includes a postponement on the Chinese front as well. So, we're looking at our trading partners. Mainly, the tariffs had been focused on our six largest. Those were Canada, Mexico, the EU, China, Japan, and South Korea. So we continue to watch some of those. The EU, Japan have made some major deals here in the last few weeks. We're starting to see some of that uncertainty, right? Overall, start to parse out, right? And the market just doesn't like uncertainty. So we're starting to see some more certainty is certainly helping. Now we started the year with an effective tariff rate around 2%, and right now I think it's around 15, 16. So definitely higher, but that's lower than the 25% or higher that was on the board. So, relative to expectations, I think we've seen some things improve. And I don't think it's going anywhere, but overall, the fundamentals remain on the train tracks. And I think that that's what's important.
And then the other one I would just bring up, Josh, is for years, we were starting to hear people say the 60/40 portfolio was dead because of, where interest rates were on bonds. Now in 2022, when rates went up as fast as they did, all of a sudden the bond market and having, 30, 40% or whatever percentage people have in their portfolio in the bonds, they're actually being compensated very well now on that 60/40. And maybe you could just take a minute on, speaking to bonds and where rates are for a moment, and the whole idea that, if interest rates go down, that's actually good news for bonds on the appreciation side. And even if rates stay the same, they're being compensated well on that. So maybe just take a few minutes and share that with our listeners.
Yeah, 2022 hurt, right? It was one of the largest increases in Fed rates since the 70s and 80s, right? It definitely hurt. I think what's different now is, we were begging for high quality income, 2 to 3% rates, just a few years ago, right? Not as protective, if interest rates spike. But now, right, we have, particularly on our taxable or some taxable strategies, income around or yields around 5%. Our muni yield, current yield on the munis is over 4%, right? On a tax equivalent basis, that's pretty good. So again, a higher interest rates does a lot, to bring in income for those who need an asset class to play defense. We're seeing that start to show up in the performance numbers that I showed on that market scorecard. And I do think that fixed income with those 5% rates of return, I think that's going to go a long way in helping with those returns moving forward, right? We were hearing, a couple of years ago, there was no alternative,
Right.
right? There is an alternative now. And I think that that's really helpful for diversified portfolios. The other thing is, and we just talked about it on the sentiment side, we've heard with Warren Buffett that Warren is washed up, and usually every time someone makes some that kind of comment, right, the market comes right back. So we hear that the 60/40 portfolio is dead. Well, once again, the sentiment swing there probably went a bit too far, and diversified portfolios are coming back in a good way this year.
Very good. So I think at this point, Josh, I don't have any further questions for you. I would like to thank you for the time that you spent with us today. We appreciate the insights and our partnership with Clark Capital. Again, for all of our viewers that are watching this live, or whether you're watching the repeat of this later, um, I thank you for the time. I thank you for the opportunity to serve you and to be of value to you. I wish you a great evening and a great day. Enjoy the rest of the summer, and we'll catch you at the next quarter. Thank you so much. Have a nice evening. And Josh, thank you for being with us and for sharing. Always appreciated. And enjoy the rest of the summer.
Yeah, you too. Thanks, Frank. Thanks for having me on. Take care, everyone. Enjoy the summer.